South Africa's current account deficit widened in the second quarter. It came in at 82.8 billion rand. That's 73% higher than the prior period and marks the biggest shortfall in a year and a half, driven by weaker exports and higher payments to foreign investors. The deficit equates to 1.1% of GDP, overshooting expectations of 0.7%. The Reserve Bank says a smaller trade surplus and rising import costs weighed on the outcome. Mining production surprised to the upside. Output for July increased by 4.4% in July, accelerating from May's near 3% increase. That overshot market forecasts of 3.2% growth. This marks the third straight month of gains, supported by stronger iron ore and PGM output. FirstRand says it's delivered a strong operational performance for the full year. That as all of the lender's large domestic businesses produced high-quality growth in earnings and improved returns, and this helped lift the group's headline earnings per share by 10% during the period. That performance helped absorb the impact of a 2.7 billion rand pre-tax accounting provision linked to a UK court ruling on motor finance claims. A final dividend of R2.47 per share has been declared. This takes the total payout for the year to R4.66. That's up 12% year on year. For the 2026 financial year, FirstRand expects normalized earnings growth to trend up into the high mid-teens. This is significantly above the group's long-term stated target range of nominal GDP plus 0.3%. Discovery shareholders have made bank. The group has increased its final payout by 32%. That means investors will receive just over R2 per share. This comes as the firm reported a 30% jump in headline earnings. That's off the back of strong growth across its operations in the past financial year. And Discovery Bank recording its first profit in the second half, which is ahead of schedule. Lesaka Technologies is excited about the prospect of completing its 1.1 billion rand acquisition of Bank Zero. The deal was announced back in June, and the firm is hopeful that several synergies and growth opportunities will arise from the transaction. The comments come alongside a preliminary results release for the full year. For the 12 months to end June, Lesaka reported net revenue of 5.3 billion rand. That's at the midpoint of its guidance and compares favorably with the 3.8 billion rand recovered in the prior period. Lesaka chairman Ali Mazandarani says 2025 was a strong year for the group, and he expects that momentum to carry into the next financial year. The firm expects adjusted earnings before interest, tax, depreciation and amortization growth of at least 35%. Bidvest has successfully priced a US dollar-denominated senior unsecured 7-year bond of $500 million. It carries a coupon of 6.2%. The firm has also announced a concurrent any and all tender offer on its outstanding $478 million notes that are due in September 2026. That's conditional upon, among other things, the successful completion of the new notes offering. Further afield, the attack of Russian drones in Poland has reignited safety concerns over the vulnerability of civil air transport in Europe. Here's more detail in this package report.
The incursion of Russian drones into Poland this week was yet another harsh reminder to airlines of the challenges presented by global conflicts. Poland shot down the drones in its airspace with the support of military aircraft from NATO allies. But aviation and insurance experts say it's led to safety concerns over the vulnerability of civil air transport in Europe. At least 4 key airports in Poland were temporarily closed before resuming operations. Growing conflict zones around the world have raised the burden on airline operations and profitability. Ryanair CEO Michael O'Leary warned the Russia-Ukraine war would be an ongoing issue for all European airlines for years to come. Carriers face fewer route options with airspace closures in multiple regions, including Russia, Ukraine and the Middle East. Detours then add to fuel costs and lengthen journey times. The coordination agency Eurocontrol has said Ukraine's closed airspace has added to congestion in the region's skies. Many international carriers have suspended flights to the area due to fears of missile and drone interference. They're also keeping a close eye on conflict in the Middle East, including Israel's attempt to kill Hamas leaders in Qatar. Worries about further disruption for the travel industry are pressuring airline stocks. Shares in British Airways owner IAG following the latest incident, while EasyJet, Lufthansa and Ryanair also fell. One expert said airlines may now review their risk assessments in Poland, while two senior aviation insurance sources said the market was watching events in Poland and Qatar closely.
Meanwhile, Meta Platforms and TikTok successfully challenged the EU's calculation method for a supervisory fee but won't receive refunds. Instead, EU regulators will recalculate the fee according to revised guidelines. Let's take a look.
Meta and TikTok won a legal challenge with the EU. It was about the way the bloc's regulators calculated a supervisory fee imposed on the companies under landmark tech rules. Meta and TikTok sued the European Commission after they were hit with a supervisory fee of 0.05% of their annual worldwide net income. The number was to cover the EU executives' cost of monitoring their compliance with the Digital Services Act. The size of the annual fee is tied to the number of average monthly active users for each company, and whether they post a profit or loss in the preceding financial year. The firms argued the EU's methodology was flawed and led to disproportionate fees. The Luxembourg-based General Court sided with Meta and TikTok. It gave EU regulators 12 months to fix their approach using a different legal act. But they said regulators don't need to repay fees paid by the companies in 2023 for now. The Commission said the court had confirmed it sees no issues with the principle of the fee nor the amount. The EU's Digital Services Act launched almost 3 years ago. It requires very large online platforms to do more to tackle illegal and harmful content on their sites, or risk fines as much as 6% of their annual global turnover.